Wow, this morning starts with two reports, one suggesting that Microstrategy is a Ponzi, this is straight from Wall Street, and another suggesting that our recession window isn't over, it's actually just begun. Both of these reports come right after an interview from the CEO of TWC, just on with Bloomberg, and in this interview, she discussed that something that made her the most concerned was that she listened to a panelist at Davos, the whole economic forum that's going on, and the panelist who was speaking said that the business cycle is over. There can't be a downturn anymore because of all the investments in super cycles like artificial intelligence. She said this extreme optimism made the hairs on her back, or hairs on the back of her neck. Yeah, that sounds a little more appropriate. Stand up. Anyway, kind of an interesting way to start the morning, especially when Delta Airlines just missed on its forecast revenue, leading the stock down about 9% in the pre-market. Not that this one matters so much, but when you look to the American stock market, but it also comes the same morning that Puma falls to its lowest level in the European stock market since 2017, with its margin expectations coming in lower than expected and its net income coming in about half as much as expected. That stock had just had its worst intraday fall since 2021, falling over about 21%. But we're going to focus mostly on the U.S. market here and what's going on, especially since today is starting like it potentially may be a little bit of a red day. Probably just a give back after some of the euphoria we saw yesterday. I mean, consider it for a moment. Yesterday, ARM was up 15.9%. Today, you're giving back about 4%. This is interesting that Coinbase is still below $300. Nvidia is giving up about 1.5% as well, but again, it was up 4.5% yesterday. So you're having a little bit of that give back day. And look, American Airlines initially dropped 9%, but it's only down 5.6 now, so who knows? Maybe the euphoria and excitement can keep going. I mean, after all, Robinhood just shot up above $50. It is down 1.56 in the pre-market though. So what are some of these warnings that we just ended up getting from some of these institutions, and why are we getting these? Well, I'm going to show you, and we're going to go through them together here. So first, let's go start with what Greenlight Capital just said. So Greenlight Capital rips Bitcoin, well, specifically MicroStrategy. They suggest that we're in the, quote, fart coin part of the cycle, and that MicroStrategy is just a Ponzi scheme, and that it's a way to extract premium from the market to buy Bitcoin at lower values. They also question how Trump coin can end up making Donald Trump more money, potentially as much as $32 billion, although obviously they don't have the liquidity nor the ability to, there are some lockup restrictions holding apparently insider coins from being able to be dumped, but some people say there are plenty of wallet addresses that have not indicated any purchases yet are selling. So some people suggest there are faux lockups and that people got certain fart coins that they're able to sell on the inside. Anyway, I don't know. But anyway, I want to show you the actual PDF here. So take a look here. Donald Trump was inaugurated yesterday. While 2024 was dominated by election uncertainty with the election now behind us, it actually feels like we're faced with more uncertainty than ever. We know who the president is, but it's any guess as to what he'll do. We've carefully followed the campaign, but we don't seem to remember any discussion about territorial expansion. Trump is now interested in taking over Greenland, Canada, and the Panama Canal. This could be Manifest Destiny Part 2, the new American colonialism, with Trump negotiating all of it, basically. Here, then, they talk about how we're at the fart coin stage of the cycle, where you have essentially meme coins that can trade at 24/7, yet other than trading and speculation, they serve no obvious purpose and fill no obvious need. They say that lest you think it's likely to go to zero, it could be the pets.com of the cycle, Fartcoin is only the latest meme coin. Then they sort of talk about Doge, She. They also talk about how if Fartcoin were a stock, it would rank about 180 in the S&P 500. This is where they get into starting to talk about MicroStrategy, where they say they own a small software business, and because they sell for a premium, right now it's worth noting MicroStrategy sells for about 2 times as much as Bitcoin they hold. So they hold about $42 billion in Bitcoin. And let's just take a quick check here. MSTR, if they hold about 42 in Bitcoin, yeah, they're at about a $93 billion market cap. So just divide the two, they're trading for about 2.2 times their value in Bitcoin, right? And now people say it's okay to sell for a multiple of book if you actually have an underlying business. You know, that's how real estate trades, for example. But when people look at MicroStrategy, they're like, wait a minute, but literally you guys aren't doing anything. You're buying Bitcoin and then you are plopping it into your balance sheet, and that's it. You raise money, buy Bitcoin, raise money, buy Bitcoin. And people who like MicroStrategy, of course, counter this and say, no, their software business is fantastic. And, you know, this is where other people come back and say, okay, then why does the software business not make money? You can see that right here. This is the last quarterly report for MicroStrategy. Now, in fairness, they are including digital asset impairment losses here to save some money on taxes when Bitcoin goes down, or, you know, the value of whatever they have goes down. You could actually ignore this portion though. So what you should do is take this gross profit of $81 million. This is from their actual product licenses and subscriptions, and then subtract from that 81, take the 35 out for sales and marketing, take 33 out for research and development, take 33 out for G&A, and you've got a business that lost $20 million in that quarter. Now, obviously, they made substantially more in their Bitcoin investment, which is why people come back and argue, hey, like they're making a lot of people money, so are you all just bitter because you underperformed or something? Maybe. But anyway, they say that the idea of MicroStrategy is to raise money from new investors at a premium and use the proceeds to buy more Bitcoin. Since the Bitcoin that MicroStrategy buys costs less than the Bitcoin implied value of MicroStrategy stock, the new investment is dilutive to new investors but accretive to existing investors. In other words, the more the company can basically sell Bitcoin to other people in the market at $200,000 a coin, the existing investors win, but all the new investors get burned because the new investors are paying $200,000 for Bitcoin that's worth $100,000 and a money-losing software business. The old investors are like, hell yeah, they got somebody to pay $200,000, you know, to 2x basically the value of Bitcoin. So this is where he goes on to say that as Bitcoin itself yields nothing, the Bitcoin yield that MicroStrategy talks about, or Michael Saylor promotes, is really just a yield of the Ponzi finance's effectiveness. Basically, the more people buy in, the more effective the Ponzi is. This is at least what Greenlight Capital is saying. And again, you know, maybe they're just bitter. You know, they go on to talk about how leveraged ETFs have to reset daily, and something like a MicroStrategy multiplier, you know, a 1.5 or 2x multiplier on MicroStrategy is something that's likely to go to zero at some point in the future. Now, they also then argue that the overall valuation of the market has been high, and as a result of that, they argue that because valuations like even Apple, with no revenue growth but a PE multiple expanding from 22 to 37x, is unacceptable to them. They argue that they have underperformed the market because they didn't want to be a part of this. So some of this could be part of their problem, right? It's possible that because they're underperforming, that they're frustrated, and they're sort of lashing out. See, they say here, look, Apple's gone from 22 times to 37 times, and maybe it'll even go to 45 a year from now. It might, but we don't see why it should be appealing to invest in at this valuation. So here's just sort of an example where Greenlight Capital is making it clear that, hey, look, we think valuations are nuts. Here's what we think is going on in the market. We were outperforming the market until August. This actually happened to a lot of people. A lot of people got spooked by the market in August because of unemployment trends. I'm not very happy about the unemployment or job trends either. And then underperformed, so outperformed the first 8 months of the year, and then underperformed the last 4 months of the year. Well, the last 4 months of the year are usually the most important for outperformance. But anyway, so that's Greenlight Strategy's take. But it's really interesting because it comes at the same time as Piper Sandler says that the ongoing job market continues to slow and that the recession is actually just now beginning to become a reality rather than not a reality. Now, this is really interesting. They say the ongoing slowdown in job growth marked by falling job openings and slower payroll gains signals a weakening labor market. The market anticipates at most 2 rate cuts this year, but a rapidly shifting economic landscape in 2025 could change these expectations. They say a soft landing remains possible, but a somewhat turbulent environment in 2025 should lower the Fed funds rate to 2.75. So they actually see potentially, I mean, that would be closer to 5 or 6 cuts as opposed to what the market is currently implying, which would only be 1 to 2 cuts. So they say there's little reason why the downtrend in the labor market is basically not going to continue. In fact, we just had unemployment claims that came in a little higher than expected. That's spooking markets just a smidge. Unemployment claims are a relatively lagging factor. We really need months of that sort of data to really understand what's going on. And generally, the labor market is just such a lagging indicator of recession. Nobody really pays attention to it until it's too late, which makes sense. I get it. But anyway, they talk about how the establishment survey suggests we're growing, but the household survey is still suggesting the downtrend is continuing, and this is a problem. This is something to watch for. And again, this is total employees right here, whereas household has basically leveled off. This is potentially due to multiple job holders. When you have multiple jobs, you are more likely to show up on the establishment survey twice, and this could be what explains this sort of wedge between the two here. Anyway, during the or when you also see drops in temporary labor workers, you tend to be preceding recessions. You can sort of see those drops in temporary employees and how we've had that drop in temp employees over here. They also say that policymakers now expect 2 rate cuts in the coming year, while markets only expect a 50% chance of that second rate cut, so basically only 1.5 rate cuts being priced in right now. Their argument is that over the past 40 years, recessions have typically followed 2 to 12 months after the yield curve uninverts. With the curve just turning positive, the recession risk has not closed, rather it has just opened. Historically, the timing depends on various factors, including the broader economic environment, monetary adjustments, and external shocks. The likelihood of a 2025 recession is further supported by recent trends in the unemployment rate. Historically, recessions are preceded by a gradual rise in the unemployment rate, forming a U-shaped pattern before the downturn. This contrasts with a soft landing, where the unemployment rate remains stable or actually declines, reflecting continued economic strength. As a result, they actually think investing in bonds right now is a good strategy. Now, I have been, talking about bonds since August, actually since about July, which obviously has been premature. It's been very premature. Let's just say it's been wrong. It's been premature. And I'm not looking for a confirmation bias here. I just think it's interesting. This is is sort of what institutions are talking about this morning. I think we have to take both of these with a grain of salt, though. Greenlight Capital is probably just sort of in their letter to their shareholders trying to explain why they underperformed the S&P 500. And so I think they're sort of lashing out at sort of some of the euphoria that's going on. Well, let's be real, valuations are high. But there is truly this movement by people that think, oh, there's never going to be a recession again. Everybody's got an app on their phone and they could all buy the dip on stocks. That stuff like that makes me nervous. I actually think it's lunatic. How should I say it? Lunatic? Only lunatics, there we go, would say that there will never be a recession again. I am highly concerned, and I don't know when it's going to happen, but that the next recession is going to be one of the worst ever, because the barriers to get a job again are going to be so hard. It's not that I actually think that overvaluations correcting have to correct so miserably, although there will be substantial valuation corrections. It's just that when the recession takes hold and people lose their jobs, I really worry that when people go back to work, that it's going to be really hard to find that work going back to work. And that's what makes me the most nervous. And so that's why I've been really just trying to combine my fear of what artificial intelligence means. And it's good. In the long term, I agree with Elon Musk that it probably means some form of, universal rich income. I love that idea, and I'm very optimistic about that. I'm just sort of very nervous about the path between now and then. And while I'm hopeful, I also want to be careful. I mean, look at AST Space Mobile, for example. They've run. They peaked out in September. They're down 47% from then. They're down 14% in the pre-market because they issued convertibles. As soon as companies start missing earnings and then they issue debt and they talk about cutting costs and they start laying off, the cycle begins. And the cycle usually begins very rapidly. And I think, for the last 6 months, the markets have been like straight up. People have sort of been lulled into this feeling that, things can never go down. I mean, things can go down way more than I think people think, and it's going to be way more than a buy the dip. Again, I hope that doesn't happen. But again, this Greenlight, who knows? Maybe they're bearish because they missed. But Piper just sort of reminds you that there are still underlying trends that have weakness, and to be careful. Anyway, that's what I got for you today on the Morning Report. Thank you so much for watching. Feel free to subscribe if you like this sort of content. I'll keep bringing you different perspectives every single day. Thanks so much for being here. See you in the next one. Goodbye. Good luck. Please subscribe.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.